We're here. Let's go. Okay, thanks so much, everyone, for joining. Okay, so guys, welcome everyone. Thanks for joining us for part of our webinar series here at Suade. I'm Tom Fairey. I am the Chief Revenue Officer here, and the two people I shall be introducing very shortly who are joining us, and it sounds like it's going to be a very good conversation. The reason I'm so excited about this particular discussion, and I think you will be as well, is that we're all sort of still reeling from the collapse of SVB and Credit Suisse. And it's clear from that I think the compliance and just meeting with reporting requirements probably isn't enough. And so while the banks are meeting the minimum requirements on paper, those particular banks still suffered fatal consequences as a result. Now, with things like social media and digital banking and a difficult economy, the consequences, as you're all aware, can be sudden and fatal. And this is an important lesson for all banks to learn. So they have to go above and beyond those regulatory compliance to ensure they are truly safe and sound. And compliance is the bare minimum, while regulatory compliance is a necessary step. It's not enough to protect those banks from a crisis. Therefore, things like risk management are absolutely key, and transparency is absolutely crucial. Now, I'm not an expert in this area, but my two people joining me on the panel today absolutely are. So let me introduce them. First, I'd like to introduce Fiona Humphries. Fiona is an executive level financial services professional with a successful history of 25 plus years of risk management with companies, including most recently directly working at SVB, and where she's been envisaging and leading innovative approaches for implementing enterprise-wide business solutions, yielding marked results and also regulatory findings to closure. Fiona is experienced in guiding boards and board-level committees using appropriate messaging and information delivery. With her extensive background, including roles at the LFI program, as the LFI program lead and senior managing director at Silicon Valley Bank and head of CCAR program management and governance at Deutsche Bank, I think Fiona will be able to offer us more than just some valuable insight into the product, into the topic. As my other person joining us on today is Suade Misri. Suade has 16 years experience in regulatory affairs, compliance, risk assessment, and quality assurance, working with companies such as Citi, Goldman Sachs, Broadridge Bank, and Tokyo Mitsubishi, UFG. In her current role as head of wholesale credit risk and regulatory relations, Suade has invaluable insights into regulatory relationships and how to implement effective collaboration in the wake of market stresses. Now, let's just get straight into it because we're a little bit behind schedule. So I'm just going to jump in with my first question. My first question is this, and this was one that was sent in prior, and I think it's a really great one. How has the dynamic of the relationship between banks and regulators been impacted by the crisis? That's my first question, and I'm going to fire that one over to you, Fiona, to kick off.
Thanks, Tom, and thank you for the wonderful intro. I think the relationship between banks and regulators, as everybody who's on this call and ever been in that position knows, is an ever-changing it's dynamic and the way it occurs. I think what we've seen a lot of over the past years, as we've as various things have rolled out, we've seen, the response to the 2008 crisis. Regulators, particularly in the US, came down very strongly on banks with, things like CCAR and CLAR in the liquidity space, and the increasing number of, you've mentioned before, regulatory reporting. I think there's been a change in the way that they've been operating. Sometimes they operate on site. It's that kind of relationship that you might have with your audit function. There's got to be the independence. Your overall goal is the same, the strength and stability of the financial system, but you also, obviously, each person has their own agenda. But it's got to be a trusted relationship and a trusted partnership. And I'm not sure that they've. I don't know that we've actually seen the full outcome yet. Since the SVB signature and various other collapses. I think, like you said, people are still reeling from it. Regulators are under a lot of pressure to actually do something. People are looking for the one thing that happened, the bogeyman. you got to understand too, for regulators, it's political, even within the various branches of the regulatory bodies, as well as each of the individual agencies. I know that there have been a lot of them. The Fed in particular is under a lot of scrutiny right now. That's obviously out in the public. And I'm sure there's some other agencies that are going, oh, thank goodness it's not me in the spotlight. So I think we haven't yet seen what's going to happen. I'd like to see that we do revert to a bit more of open conversation. Like I said, if you're having a trusted partnership, you need to have that two-way street. I think we also need to make sure that there's a smattering of, experience, and that goes across for the banks as well. I think if there's anything that's kind of come out of this, recent crisis, and every crisis you see, things are great. They go well when, in good times, but it's how people can react when there is a problem. And I think it's, we've seen changes of experience. We've seen a lot of regulators go out into the industry. In banking too, we've seen, a number of, younger, less experienced people come through often, and maybe it's, revisiting those level of experience. I think there's a lot more to come there. Tom, you're on mute.
And it's better to be off mute for these things. Suade, can you speak to a little bit about how you think that relationship between, say, the Fed and the banks, how that collaboration should work? I think we're struggling to hear Suade there. Okay. In the absence of Suade being able, just while we're sorting out some technical issues there, Fiona, speak to me a little bit more about how do you think that, talk to me about the importance of that collaboration and the kind of processes that are being implemented to decrease that exposure going forward.
Well, I think that's what we're waiting to find out from the Fed. As you know, there was a report that came out in May of the, what the findings were and the implications of the collapse of SVB, and obviously SVB is one I can talk to a little bit more. Again, I think it goes back to people are trying to find one thing that went wrong, and I think this was a classic case of multiple things happened. Since it's the first time since 2008 that we've really, smartphones were in their infancy back then, whereas now, you can be at the gym. You've got your smartwatch, you get a beep, a notification, you can immediately get onto your phone, you can trade stocks, you can move money in your bank accounts. And also the markets are open to a much wider range of people. So we saw, that kind of speed was really what impacted SVB and that, fatal kind of 48 hours. And I think those are kind of some of the things that regulators really have to think about. You talked before about soundness and stability, and that's really what our financial system heavily relies on, is perception. At social media and the role it now plays in our everyday lives, coupled with, technology, digitization. We're all under pressure to keep digitizing, to keep automating. But what we've seen here is maybe we need to also think about the kind of controls that exist. In the stock market, for example, you have circuit breakers. If the stock price starts moving into, the volatility starts getting too high, we don't really have that kind of functionality. There are elements of that organizations have, and maybe something that was, SVB maybe didn't have strong enough ones on that side, but maybe there's a concept of perhaps circuit breakers and things that we can think about in the banking system. So I think from a regulatory perspective, they need to be thinking right across the board. It's not just a matter of putting more regulation and more burden on the firms. We already know from a regulatory reporting perspective, we have hundreds and hundreds of schedules that we're constantly having to populate and get out on a certain timely basis. And a lot of the time, I know we question what exactly are all of these being used for, and really are they all being used with certainly the frequency that we have to provide them. So I think there's areas of that that we need to look at. We're inundated with information, and so the ability to be able to sift through what is really relevant in an incredibly fast-moving environment. Those are some of the key things. And then I think one of the other key points with especially like SVB and a number of other firms you see at the moment is rapid growth. SVB's was organic, others come through mergers and acquisitions. And the speed of that growth, if you don't have the levels of controls and the risk management that is necessary for those levels. And I think it's really understanding both from the financial services side, but also from the regulatory side, what does that look like in practice? We've all gone through, we've looked at different frameworks, we calculate ratios and all of those things, but what does that really mean? You mentioned, Tom, my role at SVB was the LFI program, Large Financial Institution program, and that was building capabilities for SVB as we were moving through the categories. Now, one of the things that I found in my role was I could build literally to those capabilities and the expectations of the regulators, but then it was kind of that more the how around that, and like you said, it's not just here's the ratios and those kind of things, it's the qualitative elements of that, and that's a lot harder to kind of understand, is the quality of where the firms are at. But that's definitely where a lot of the focus needs to be going forward, but not just piling on more and more regulation.
Yeah, that makes sense. So do you think that an effective way to combat these going forward, listening to things you said and the examples you gave in day trading and so forth, do you think there should be more focus on things like real-time data and better standardization and to utilize this more? Is that something where you think that the focus should be more on, and that would alleviate some of these challenges if that was happening?
Well, I think in some respect that was actually part of the problem for SVB, was the real-time data acting out in the public arena, but the regulators weren't actually able to react themselves in the real time. So I think it's that discrepancy between the technology that's available in the institutions that are in the system versus that we have, in our hands today. Kids at school have better computing power and things like that than we do often in our own organizations. So I think from that perspective, there's a technology mismatch. I think, again, you can have a lot of data, but it's the ability and the tools and that to interpret the data, to know what's important. And then it's having the people who can interpret it and can identify where the problems are arising. And then you've also got to have the people who are willing to actually do something about it.
Yeah, sure. And so I guess, so from your perspective, and just when we look at these specific examples that we spoke about, Credit Suisse and SVB, which you can speak to more directly, do you think that if they had these better controls in place, these things would have been avoided, or do you think it was something that couldn't have been avoided? Do you think it's something that would have happened anyway, or do you think that had they had better reporting functions or whatever, then it would have been avoided?
Credit Suisse was definitely a risk management issue, and it played out through a number of different things everyone's familiar of over a number of years. I think the kind of timing of that got accelerated, but I think that was definitely a risk management and control issue. But SVB, there was to some degree, but I don't think any additional controls at the time would have made any difference to what played out. I don't think any regulatory reporting would have made any difference to the SVB scenario at that time. Not to say that obviously there was improvements, and obviously there's things that we need to be focused on. But it goes back to, again, I think the regulators need to take a look at some of this regulatory reporting and see, well, what is it that's really really crucial. Perhaps more on the real-time stuff, it's that liquidity element of things that might be, a lot of the reports in that are run on a daily basis already, but maybe more needs to be looked at on the intraday, where those kind of flows are, what those type of limits, and a lot of banks have controls and limits on those, but maybe a lot don't. If you're talking real time, then definitely in the liquidity space, there's a lot more need for it. from a risk management perspective. But then you've got to, again, have people who can react to it. So you've got to have the people with the right expertise and the ability to manage the risk.
Okay, that makes perfect sense. I think, like, so focusing on that a bit more. So as the risk of a bank run, as we mentioned sort of in the intro, we're talking about, and you mentioned about the real-time data being shared publicly and with social media and the power of that, with that bank run risk being higher than ever, fundamentally, you know, and you can speak to this more than I can, but certainly the banking business model hasn't really changed. Is there a better way of doing business as a bank, i.e. like improved risk management frameworks or transparency? Can you speak to that at all?
I mean, I think what the interesting thing we're seeing at the moment, playing out in the United States in particular, is kind of a bit of breaking of banking 101. If you think, you know, fundamentally a bank gets in deposits, may or may not pay out on some interest of that, and then lends out money, obviously at a higher rate, and you know, basically the difference between the two is kind of where you make your money. That's very, very basic, you know, banking 101. Obviously banks do a lot more than that. But what we're seeing, and I think this is again where the United States is a little different from a lot of other countries. We have a lot of, you know, the smaller regional banks here. You know, every other town seems to have its own bank. And while we lost a lot in the crisis, you know, those they still, you know, exist in their thousands, and those are the ones that, you know, cater to Middle America. And the idea that a lot of the deposits have actually gone to the bigger firms, who, you know, the big banks that might not necessarily don't want to do the business for, you know, lots of very valid reasons, or a lot of money got taken out of the system and put into things like money market funds, or have gone to the shadow banking industry. I think we're starting to see a little bit of a breakage in, you know, in that where the money coming in is not where the money needs to go out. And we're starting to see a little bit of pressure in kind of that, you know, commercial real estate area. We're already going to see some of that anyway because of the pandemic, but I think some of this is going to exacerbate this and put even more pressure on regional banks. Again, then there comes back to perception of stability. So I know that there's been a number of conversations going around about and some, you know, former regulators and people looking at different kind of payment organizations, or again providing services that are not pure banking services. And I think that might be an area that we start to see an increase in, is that facilitation of payments. There's also been obviously discussions around insurance at the regulator, at, you know, like the Federal Reserve and things like that. But a lot of what that will do is just put additional burden on banks of holding capital and things. And, you know, as we saw at SVB, capital didn't actually help. Yeah, I think even Randy Quiles came out a few weeks back and said, you know, you'd be surprised if any bank could have withstood that type of run.
Yeah.
So, you know, it's that I don't know. I think we've got a lot of interesting things we're really seeing, and banking itself. I think there's a lot of fundamentals are being turned a little bit on their heads at the moment. I mean, and the same with, you know, with what happened with Credit Suisse, with the Swiss government, the way that they, you know, did the purchase with UBS, and the fact that the shareholders, while not being given a vote on what happened, were still kept, you know, none of that, they didn't lose out, whereas the AT1 bondholders did. And we know there's a lot of legal action going on there now. We're actually also seeing an increase, I think, in a lot of investors also of just putting some class actions together against the Swiss government. But again, they've broken some of the fundamentals of the way we think about valuing firms and that as well. So I think there's a lot of different elements coming out of what we saw, you know, in that very small period in March.
Nice. No, it's really interesting. So look, I've got one more question personally before, which is entirely selfish as a technologist. Before I open up the floor to the audience, but the question I have personally is like, how will the recent events serve as a catalyst for institutions and regulators to accelerate the adoption of technology and data standards? Do you think it will serve as, do you think that we'll look back at this and say, actually, because this has happened, therefore we have to try and make a difference, we have to make this more standardized, and we have to bring technology into this process, because at the moment, as we all know, everyone on this call knows, it's a very largely a manual process, and that may be some of the reason that some of these things happened. And so do you think that this will serve as a catalyst, or do you think actually nothing will change?
I mean, I think probably most of the attendees on this will agree. I feel like we're always trying to improve on data. We're always trying to improve on technology. It's always a race to do something, and it's always you're battling over whatever it is, the flavor of the month or of the day. At one stage, CCAR was all the rage, and that was everything was focused on that. KYC, anti-money laundering has been a big one that still continues to be a big focus. Cybersecurity is obviously one that continues to grow in importance and in focus, and you see a lot of that's all the discussions around AI and things like that coming into play. I don't know whether it's a catalyst, because I think people are constantly trying to improve anyway. A lot of banks have had to lay off a lot of people, a lot of technology firms. Every time you have to do that, and we're still trying to do manual reports, and you've still got deadlines, you've got to replace that with some form of technology or some other better efficiency. So I think what happens is regulation that comes off the back of some of this stuff enables people to then try and get investment to do it, or it becomes now the focus of whomever is making the decisions or signing off or allocating resources within the firm to do things. I think it certainly makes.
Can I dig into that a little bit, just while we're
Sure.
on that? What is your view on the personnel aspect of the failure of specifically SVB? Because I know you can speak to it. I don't want you to chuck anyone under the bus here, but what is your personal aspect of the failure at SVB, and how greater accountability can be used to prevent a repeat of future events in the future?
I want to be careful here. A lot of these people are my friends, and I have the utmost respect for all of my colleagues. My heart's still broken for the failure of SVB. I think one of the things that, like I said before, around capabilities and risk management, I think we do need to be. From a managerial standpoint, we need very talented managers who can identify the right skill sets, where people are performing, that you have, and people understand that if you're overseeing a $50 billion bank, it's not the same as overseeing $100 billion, $200 billion, those kind of things. When you put it in context of, if you're at something like a JP Morgan or at a Citibank, and you might be overseeing just one division, that's probably the same size as two or three, other kind of regional banks. So it's understanding there is a significant difference between when you grow rapidly and what you now need to be thinking about, and what the key elements that need to be focusing on. So, that would be something that, if I was the regulators, I would, be more mindful of when you're looking at the people who are accountable for areas such as treasuries and finance areas and things like that, risk taking and risk management, that the people's skills are commensurate with the amount of risk that they're needing to take. And there's the acknowledgement of that.
Fantastic.
But there's no easy way to do that. Just, I don't know the solution, but it's tricky. You're dealing with people.
No, it is hard. It is hard. Absolutely. Okay, so I've spoken quite a lot. Is there anyone in the audience who would like to ask a question? If so, please raise your hand, and we will unmute you so you can ask a question. Anyone there? Okay, everyone's far too shy. That's fine. No problems at all. If you do have any, please do raise your hand. Okay, so I have a couple more questions which I just wanted to go through. And guys, all of you who are listening, sincere apologies. Twitter unfortunately was unable to fix some of the technical issues that we had with our camera and mic. I will ensure that she joins us on another one. I think she'll be able to bring some incredible insight. That's by no means saying that Fiona hasn't been amazing on her own. That's before
No, I was looking forward to having the conversation with Shweta as well. But
yeah, absolutely. So I think the last question, again, for me, it comes down to a technical question again around whether you think, because we talk about the accountability, and you did speak to more people coming in, but I just wanted to sort of understand a bit more. By bringing technology and being able to banks being able to access data quicker, report more quickly to the board, report more quickly to the regulators, and so forth, do you think that will prevent things like this happening again in the future? Pretty black and white question there, I think.
No, I think the one thing that we learn is, every time we have a crisis, we learn something else about where there was a weakness or where there was something. A lot of our industry is set up, the way we incentivize a lot of people is to look for the best ways to make money, and in doing so, they're always going to try and find the easiest, cheapest, best way to do so. I don't know. I think it's every crisis we find something new, and then we try and solve for the crisis that's just been. So I think that the more that we can look to the future, look to the what ifs, it's one of those things when you talk with people about stress testing scenarios and things, and they say, oh yeah, we ran this pandemic scenario, but it was put down as, oh, that's never going to happen, and we all know what did happen. I think that would be one area that would be be able to run more regular type scenario analysis of different things to make sure that people really are understanding the drivers of their risk. Did SVB truly understand the way that the composition of the deposits were, and what the impact of that changing from non-interest bearing to interest bearing really would have, those types of things. Not saying we didn't, but just also being able to do that. We know we have things like CCAR, but then that becomes an entire exercise in its own self. Anybody who's involved in that knows, it takes up, 3 to plus months of a year, and it's not fast enough to, by the time you're through all of that, something else is already happening. In fact, that's what we saw in 2020. We'd literally just filed CCAR and COVID hit, and suddenly it's like the regulators wanted us to run a whole lot more things. I think the more better data, faster data, more real-time ability to do that, you have a better understanding of how things might work. Keeping in mind you're always using models, and models are just a tool. They're not the end, the end game, but they're a tool to help you think what if. And I think that would definitely be an area that should be more focused, because that allows you to think forward. And instead of us always looking back and trying to fix what happened before, we still need to do that, but we also need to say, well, what if? Have we taken into consideration the changing environment of social media, the changing environment of the technology? I know that with all the conversations around AI and that these days, there's a lot of people saying, are we really thinking about the consequences? Are we really thinking about all the implications? And I think that's the right thing to do. There's, it's an incredibly powerful tools that we're going to get with AI, and we have already. But again, we need to still constantly think of consequences. And that's what risk management's all about, is that thinking ahead, that thinking of what if, did I consider? And that's when you need to bring lots of different people to the party as well, so that you're not just in that group think and always doing the same kind of thing. You're actually considering lots of different options. So that would be where I think, from a technology perspective, from a data perspective, would be incredibly valuable going forward.
Amazing. All right, that's been incredibly insightful. Thank you so much, Fiona. I think I've learned a lot here. My brain hurts. It was really good. It was really good having someone who was yeah, sort of understood all that happened and getting that direct insight of someone on that side. And so thank you so much for taking the time to share with us today. Yeah, thank you so much on behalf of everyone who's attended. I really appreciate it. For everyone who's listening, we'll be writing this up and we'll be sharing the takeaways with you. But thank you so much for attending, and I hope to see you with the next one. All right. We're here.